Hey, my name is Zach Husser, and I'm a junior marketing major at Southeastern Louisiana University. And I'm here today to give a company analysis of these three companies, Hornbeck, T-Mobile, and Toyota. But before we jump into the analysis side, let me give you a little background, just a brief background of each of these companies. Hornbeck is in the oil and gas industry. It's a relatively small company based in Covington, Louisiana. Its 2014 net income was $88,525. Stock symbol HOS on the New York Stock Exchange. The stock price is $12.25 per share. Next we have T-Mobile. T-Mobile is a mobile communications company, aka cell phone company, most recently moving into the DSL internet area, which is going to affect some of its liquidity ratios, which I'll get into later. Its 2014 net income was $247,000. Stock symbol TNUS. The stock price is $35.50 per share. Finally, we have Toyota. Toyota is in the automotive industry. It's a relatively large company with its 2014 net income being $18,122,000. Excuse me. Stock symbol TM. Stock price $124.42 per share. So what am I going to be analyzing today? Today I'm going to be analyzing what company I would give a 6-month loan to, a 5-year loan to, and then finally what company would I buy half of the stock in. So basically that means what company would I have controlling interest in. So let's jump into it. First, we're going to analyze what company I would give a 6-month loan to. And for that, we're going to look at the liquidity ratios, particularly the current ratio, the quick ratio, and the cash ratio. First up, we have the current ratio. Now, what is the current ratio? The current ratio is current assets over current liabilities, and it's a way to measure liquidity and how able a firm is to handle their short-term obligations. So first up, we have Hornbeck. Hornbeck across the board doesn't seem to have really any problems meeting their short-term obligations. Hornbeck is in, as I said, the oil and gas industry. Very liquid right now because that industry is kind of reeling. So they have a need to be liquid at this time in the company. So I have no problem with Hornbeck with their current ratio. We get to T-Mobile moving pretty nicely with a drop-off in 2014, and we'll get to why they have a drop-off in 2014, and that'll be pretty much for all the liquidity ratios, but we'll get to that in a minute. Toyota, just barely hovering over 1, which means they're meeting their short-term obligations, but they might have some problems doing so because they don't have a lot of room for leeway there. Next we're going to talk about the quick ratio. Quick ratio is another way to measure liquidity and how able a firm is to meet their short-term obligations. And once again, we see Hornbeck having no problems. They seem to be very liquid. No problems with Hornbeck. We get to T-Mobile, good, but oh wait, there's a problem. In 2014, they dropped below 1, which you never want to do because that could really indicate that you have a problem meeting your short-term obligations. Now, what the problem with T-Mobile is, in 2014, they moved to more of a company where they sell other companies' products, Apple, Samsung, and they moved into more of a service industry, meaning they now have more long-term assets than short-term assets, which really affects their liquidity. Now we get down to Toyota. Obviously, I have a problem with Toyota. All of their quick ratios are below 1, indicating that they could have a serious problem meeting their short-term obligations. They're probably having to take out loans or use cash reserves to be able to pay their short-term loans or whatever the short-term obligation may be. So kind of a red flag for Toyota, which brings us to the cash ratio. Once again, Hornbeck doing very good. First, let's back up and talk about what the cash ratio is. The cash ratio is cash or cash equivalents over current liabilities. So, for example, Hornbeck is doing really well because they always have enough cash to cover their liabilities. For example, in 2014, they have $2.23 in cash for every dollar in liabilities. So they have no problem with that. T-Mobile, once again, doing fine all the way until 2014, where they dropped below 1, meaning they only have 61 cents in cash to every dollar in liabilities. And that's once again because they're moving into the more long-term assets than short-term assets, so they're less liquid. Even though I would like to be still I would like that number to be higher than 0.61. I'd like them to have more cash to cover their liabilities. Now that brings us to Toyota. Toyota has a serious problem in the cash ratio because we see absolutely horrible 2012, 2013, 25 cents to every dollar in liabilities. That's definitely not what you want. So what Toyota, as I said in the previous slide, is probably having to do to meet their short-term liabilities is take out more debt to be able to cover those short-term loans and liabilities. So, which company would I give the loan to? Obviously, number one is going to be Hornbeck. Hornbeck, in my opinion, and pretty much anybody's opinion after you look at the slides, is by far the most liquid company. They're in the oil and gas industry, kind of an up and down kind of thing. So they're very liquid at the moment. T-Mobile, I would put at number 2. And the only solace for T-Mobile, they're very solid all the way up until 2014. So at least there's some hope that they could regain some traction in their liquidity ratios. Toyota, they're just basically on the slide because I have to put a number 3. But Toyota is pretty much awful in all their liquidity ratios. There's no way I would give a 6-month loan to Toyota. So, next question. Which company would I give a 5-year loan to? And this we're going to look a little bit farther into the future. And we're going to analyze the company's total debt ratios, the times interest earned ratio, and the equity multiplier. First up, we have the total debt ratios. Now, what is the total debt ratio telling us? It's going to tell us how much of their assets, or how much the company actually has, is financed through debt or through creditors. So you want this number to be as close to 0 as possible, because when it's to 0, that means none of your assets are financed through creditors. You pretty much own everything in your business. Now, if the number is 1, that means everything you own is financed by creditors, and you don't actually own anything. You want the number to be closer to 0, because if it's closer to 0, then you're not making as many payments to creditors. So we see Hornbeck is sticking around 0.54, 0.55, around 55%. That's meaning about 55% of their assets are owned by creditors. I'd like to see that number mostly in the 40s, meaning they own more of their assets than they're actually taking out credit for. But then that brings us to T-Mobile, which about 70% of their assets are owned by creditors, and that's a big red flag for me, because that means they only own about 30% of their actual assets. So the question is, how can they really be making money if they're paying back all this debt and they don't actually really own anything that they have in the company? Then we move down to Toyota. Toyota is kind of the best of both worlds scenario, where they're around 64% of their assets owned. They could also have a problem making generating a lot of profit, because they're also paying back a pretty good amount to creditors. Next, we have the times interest earned ratio. This ratio is going to tell us how able the firm is to make the payments on the debt that they actually have. We get to Hornbeck. Hornbeck doesn't seem to be having a problem, except for 2011. They might have had a little bit of an issue, but they've seemed to recover nicely. 2012, 2013, 2014, all consistent. Move down to T-Mobile. Have a problem with T-Mobile because, as we just said, they have the most debt financed by creditors, which brings us to 2013, 2014. 2013, it doesn't seem like they were actually able to make those payments. And in 2014, they were barely able to make those payments. And we all know if you're not making payments on loans, that's just not a good thing. So, not only do they have the most amount of debt, or most amount of assets financed by debt, they have the most problem paying their debt, in my opinion. Now, you look at Toyota, real problem in 2010, 2012, meeting their obligations, but strong recovery in 2013 and 2014 was a sign of large growth. So my main problem is with T-Mobile, because they have the most debt, and it seems as if they have the most problems paying it back. Then we get to the equity multiplier, and this is just going to tell us how much leverage a company has, and it's kind of a spin-off of the debt ratio, because it kind of gives us an indication of how much is financed by debt rather than their own company. And it's pretty much the same thing as the debt ratio. Hornbeck is the strongest. You want the number to be lower, because the higher the number, that means it's more financed by debt than it is by your own revenue. So Hornbeck is the best in this. Toyota second. Once again, T-Mobile, you see pretty much a lot of their assets are financed through debt. Excuse me. So who gets the loan? Once again, I'm going to give Hornbeck the loan for 5 years. They seem to be the most consistent in all these ratios. Toyota would be number 2. T-Mobile would be number 3. And the main reason T-Mobile, once again, T-Mobile is really bad because most of their assets are financed through debt and they're having trouble paying it back. So T-Mobile would have a tough time getting a 5-year loan for me. Finally, I'm going to analyze which company I would buy half of the stock in. So what we're going to analyze for this, we're going to analyze return on assets, total asset turnover, once again the equity multiplier, And the most important thing we're going to analyze for this is going to be return on equity. That's going to tell us a whole lot, because return on equity is going to be a combination of those three things, plus profitability margin. So return on equity is going to be the most important thing we analyze, but first we're going to look at return on assets. Now return on assets is going to tell us how efficiently the company is using the assets that they actually have. We're going to analyze it from 2012. So, Hornbeck, not bad. First let me get to T-Mobile. Absolutely horrible in 2012, negative 21% in return on assets. Reason for that being 2012, their net income was negative $7 million just in total net income. And the formula for return on assets is net income over assets. So if you have a negative $7 million, you're going to have a tough time churning out a positive return on assets. So you're going to have an impossible time churning out. But they seem to recover, relatively nice in 2013 and 2014, at least getting back in a positive area. But it's still a red flag for T-Mobile. Just really tough time after 2012. Tough to recover from that. Toyota being the strongest of the three in return on assets. They seem to use their assets pretty efficiently, around 4.3%, 4.5%. Next, we're going to look at total asset turnover. And it's going to tell us how well we're using our assets and turning them over at an effective rate. Toyota, by far, the best of these three. Not necessarily by far. T-Mobile had a decent year in 2013. But Toyota, very solid, hovering around 60, 67%. And Hornbeck just actually doing terrible in this total asset turnover, which is indicative they weren't doing great return on assets. So T-Mobile actually doing fairly well on total asset turnover, great year in 2013. Next, we're going to analyze the equity multiplier, and this is something we already did, so just give a quick review. The equity multiplier, Hornbeck is doing great, Toyota okay, T-Mobile not so great. We already did that, so we'll just go to the next one, which is the most important thing to analyze when we're buying stock, going to be return on equity, because this is going to tell us how much stockholders are getting back. So we look at return on equity for Hornbeck. Obviously, you see negative return on equity, bad. Don't really have to explain that. Anytime you see a negative return on equity, that's really bad. But they've recovered 2012, 2013, 2014. Not bad. All right, so let's get to T-Mobile. It's looking fantastic all the way until 2013, where they have a huge drop-off to 1.6, and then to 2014, negative 0.86 in return on equity. That is a major red flag. You'd never want to buy from a company that just had a year of negative return on equity. Major red flag, especially the year before, just such a significant drop-off. Bad sign for T-Mobile. Brings us down to Toyota, doing fantastic the past couple of years on return on equity relative to these companies. Kind of rough 2010 to 2012, but they've shown consistent growth in the equity department in the last 2 years. And pretty much all these ratios. You've seen the asset ratios. They've also gone up in 2013, 2014. So Toyota seems to be doing something right in these departments. So that brings me to my next point. What stock am I going to buy? I'm going to buy Toyota. They have the best return on equity, best asset turnover ratio, and the best return on assets. Just, in my opinion, the smartest decision to buy. Hornbeck, I would pick as number 2, and T-Mobile, just not looking good, because you never want to pick a company that just had negative return on equity. So, as I said, I would buy Toyota, next Hornbeck, then probably wouldn't buy T-Mobile. But anyway, so that's pretty much all I have. Thanks for listening.